reason you're missing out on every big move in the market is because you're not using this exact entry model. The first thing you need to do is read the higher time frame bias or draw on liquidity. After that, you need to wait for price to tag a 5-minute, a 15-minute, or even a higher time frame fair value gap that aligns with your drawn liquidity. While price is tagging that fair value gap, you need to see a sweep of internal liquidity. After that, you need to look for a 1-minute fair value gap to get inversed, and that's where you're going to target your entry, and then you're going to target opposing liquidity for TP. Right here, we see a 4-hour bearish fair value gap. But if you're not a swing trader, there's no way you're going to be able to catch this trade with a good stop loss, because you'd have to keep over an 800 tick stop to be able to take this trade. But if you zoom into the 1-minute time frame, you're going to see a much more dialed in entry with really good risk to reward. Right here, we generated internal liquidity with the swing high, and this is when we tagged into the 4-hour bearish fair value gap. On this move up to sweep liquidity, we created a 1-minute bullish fair value gap. Once price closes below that bullish fair value gap, it becomes an IFEG. What I do is wait for a retest of that IFEG, and I take my entry, keeping my stop above the wick of that IFEG candle. As you can see here, price retraces into the IFEG, which is where I would get my entry. I'd keep my stop above the wick of that IFEG candle, and I would hold this trade down to opposing liquidity down at this swing low. This is the best entry for catching reversals and continuations of trends.